Okay, let's unpack this one. We're diving into implied volatility today, IV for short. It sounds, super technical, maybe a bit intimidating, but honestly, it might be the most important thing driving option prices. Our mission is simple: strip away the jargon, explain what it is, yes, but also how pros actually use it.
Right. And we can make it simpler right off the bat. Think of IV like car insurance pricing. It's dynamic. If the market's like a clear, calm road, well, insurance auctions, they're cheap, not much risk perceived. But if suddenly there's black ice everywhere, huge uncertainty, big swings expected, that insurance cost, the option premium, it just skyrockets.
Okay, that analogy really helps frame the risk and the cost involved. So drilling down, what is IV formally? It's the market's expectation right now, looking forward. An expectation of how much a stock might move, usually over a year, shown as a percentage. And crucially, it's just about the size of the move, the magnitude, not whether it's up or down.
Exactly. And the fascinating part is why it's called implied. It's not looking backwards at how the stock has moved historically.
Hmm.
That's historical volatility. No, this is derived, sort of backwards, from the option's current price. People use models, like Black Scholes, to figure it out. So the option price itself already has this fear or maybe excitement about future swings baked right in.
Let's make that percentage concrete. Say a stock's at $100 and the implied volatility is 30%. What does that imply? It means the market thinks the stock could reasonably move about $30 up or $30 down within a year. That's a pretty wide potential range, isn't it?
It is,
Yeah.
and that expected range, that magnitude, directly impacts the options cost, the premium. 4B is probably the biggest driver there. Higher V means bigger expected swings, which means a higher risk premium gets built into the option, makes calls, and puts more expensive. And when IV drops, that risk premium deflates and option prices fall, sometimes really fast.
Okay, now this is where it gets really interesting for traders, I think. How strategy changes based on IV, because if IV is high, options are expensive, so people might want to sell them. But wait, wouldn't selling options when big swings are expected be, well, incredibly risky, like uncapped risk?
Absolutely. It is taking on risk, specifically short volatility risk, no doubt. But when IV is high and options are pricey, it creates a big incentive for traders to become volatility sellers. They might use strategies like, say, short straddles or iron condors or credit spreads. These plays can profit if the stock stays in a range or even just if volatility itself drops. They collect that really inflated premium up front, essentially betting the market's fear is exaggerated, that the actual move won't be as big as implied.
Right. Betting against the implied fear premium. And the flip side, what if IV is low? Options are like dirt cheap. That seems like the time you'd want to buy options, yeah. Maybe simple calls or puts or debit spreads, because your entry cost is minimal. You're betting the market is too calm, too complacent, and volatility is about to pick up.
It's exactly low-cost bets on potential big moves. And this whole dynamic, it's super visible around specific events. Think earnings reports or, big Fed meetings. You almost always see IV spike before those events happen. That premium builds up purely because of the uncertainty of the outcome.
The pre-event IV pump, and then the event happens. Stock might go up, might go down, might do nothing much at all. And almost like clockwork, you get the IV crush.
That crush is so important to understand. It's not just the option losing value over time that's theta, time decay. This is different. It's the sudden removal of that specific event risk premium. Poof, gone. The market now knows the earnings result or the Fed decision. The uncertainty vanishes, so IV collapses almost instantly, and option prices plummet right along with it, which means if you bought an option right before that event hoping for a big move, the IV crush can actually destroy your profit, even if you got the direction right.
Wow, okay. So bringing it all together for everyone listening, implied volatility is like the market's real-time forecast of future stock gyrations, and that forecast is directly baked into the price you pay for an option. Understanding IV means understanding the cost, the risk, and maybe finding the better strategy for your trade.
Right. And maybe one final thought to chew on,
Yeah.
thinking about that IV crush. If you buy an option, usually the idea is to profit from a big move,
Right.
directional bet. So why does the price of that option often crater right after the big move finally happens? It really makes you question, are you always just betting on direction? Or sometimes, are you actually betting on the volatility itself? Something to think about.